Hey, knock, knock, everybody. Derick Van Ness here, wealth strategist, investor, and life adventurer. And today I've got something that's super cool. You guys are going to love this. And we're going to be talking about how do you double your retirement income with a little bit of a twist, something that's going to allow you to understand and probably take what most people know about investing and retirement strategies and so forth, and just bump it up a huge amount. So if this becomes valuable for you, be sure to like this video, pass it on to your friends, let everybody know. If you're watching this on YouTube, you can always subscribe down below, drop a comment. If you have questions along the way, since we're doing this as a live video, feel free to drop those comments in the comment box down below, and we'll be sure to get to those. But I just want to break this down for you because here's the problem with traditional financial people and financial strategies is most people who are selling this stuff, they really have one, maybe two like tricks in their bucket, right? Like they kind of say, well, just sign up for your 401k or your IRA or your SEP and put all your money in there. Or they might say, put all your money into this particular product or this particular product or this particular product. And guess what that product is? For most people, it's what they have to sell, right? What they make commissions on. And so they're very biased. It's kind of like walking onto a car dealership lot where all they sell is Toyotas and asking them, what's the best car to buy? Well, they're going to tell you it's a Toyota. It doesn't matter if you're looking for a $200,000 car or a $2,000 car or something somewhere in between. All they've got is Toyotas, so they're going to tell you Toyotas are the best. I'm here to tell you that using a single strategy with your financial plan to build wealth is generally a dangerous game. I mean, there are some things that are rock solid and some things that are pretty hard to go wrong with, but a lot of times those don't take full advantage of upsides or opportunities that are out there. But everything's got its pros and its cons. Today, we're going to talk about something that I almost never see people talk about, and that's the synergy between different types of strategies. How do you work with these together to create a much, much better income? And specifically, I'm going to be talking about your retirement income in the stock market. How do you double that? Because a lot of people have been parking money in the stock market for the long haul. Now, if you watch a lot of my videos, you already know, I think, especially for business owners, which is who I primarily work with, that parking all your money in the stock market is, it's not a good idea. Parting business owners from your money is a terrible idea, in my opinion. And most people are doing it to save taxes. But the truth is, they're not saving taxes. They're kicking that can down the road and they're deferring taxes. They're going to pay taxes later. That's a whole nother training, a whole nother video, something that we sometimes cover in our tax masterclass. And, whatever. But long story short, I don't think that's a great idea. So what we want to do today is we want to talk about how do you create some synergy between products, take full advantage of what one product is good. And then when things change, you can use another product. And really, you can use these to stair step your way to a much, much better long-term result. So to do this, I'm going to draw a couple of pictures for you today. And I'm going to do a quick screen share and make sure that I'm clicking over to the right place here. So here's what we're going to do with this. I want to talk just a little bit about how things traditionally work with the stock market, right? Like if we have a timeline here and you're trying to get to retirement right here, right? Let's call this age 65 or 70. It doesn't really matter. It's kind of changing right now for a lot of people. And the idea here is over time, as you make money, you're going to grow your assets, right? And you're going to move those up till you get to retirement here, right? This dotted line down the middle. Now, what we're looking to do here, and a lot of times this is called the accumulation phase, as we're moving this thing up here. Essentially, as you're building up assets, you are looking to get more money so that eventually you can turn that money into retirement income, right? And that's what a lot of people forget is it's not about how much money you have. It's about how much income you can create with that money, right? So what we're really trying to do here is we are trying to build up a nest egg, but we're trying to build that nest egg up in a way that we'll be able to take it and turn it into income long term. If you can't turn it into income, what happens is you just start sucking away at the principal, right? And what I mean by that is you have a certain amount of money, and every time you take money out for your retirement income, the amount of money that you then have is less, right? And so what we want to be able to do is take that and transition those assets or that chunk of money into something that continually creates cash flow for you. So this is a really big shift for a lot of people, and they're not exactly sure how to do it. We're moving along. We're building up assets here to get to retirement, right? And this is the little flag. This is the goal. Yay, I made it there. And this part is called the accumulation phase, right? But like I said, what happens is when you get to this side of the curve, now your income has stopped, or you're relying on something like the stock market. Over time, as you pull money out, the amount of money that you have goes down, right? Now, what we know about the stock market is that the curve's not smooth like this, right? What's actually happening with the markets usually is it's doing some of this, right? We've got all of these ups and downs, right? And this is obviously an exaggerated version, but you have ups where you have a little more money, and then you have downs where you fall behind. But over time, the idea is that the market's going to always go up, right? Now, there's a lot of misinformation around what that really looks like, because the order in which you get those returns, in other words, the where the peaks and the valleys are on this, really matter for you when you get into retirement, right? Because the problem is this: let's say this is age 70 when you're going to retire, and here at age 60, 67, the market crashes. So now you only have this much money. And a lot of traditional crashes that have happened in the last couple of market cycles have been a 40% drop, 30 to 40%. So all of a sudden, you've just lost 40% of your earning power in retirement. And then you start to put some more money in, but now you're here. Can you start drawing money here? Because you won't have nearly as much. You might end up, as you start drawing money, living a meager retirement plan, right? So that's one scenario. What if we instead, let's say you get to retirement just fine, but all of a sudden, right after retirement, here at age 73, the market crashes, right? And now you've got to try and recover, and your income suffers, and your retirement's beat up, right? And we all know that based on where these peaks and valleys are, we don't have control over that. That's like a big wave of the economy and what's going on. And there are things like, the pandemic and market cycles and bank strategies and central banks and a ton of other things that are affecting our economy, right? And so the question is, how do we protect ourselves? Because here's the problem: this window where you're most vulnerable, let's call this a 10-year window, right? From age, if you're retiring at age 70, from age 65 to age 75, you're most vulnerable because you don't have time to recover as much here, or this is the very beginning of your retirement, and it could really, really hurt if you take this big hit, right? So what we want to do is figure out, how do we mitigate this, right? And just so you know, statistically, what they felt, experts who have run the numbers, they've looked at all the scenarios that have happened in the past. They run what are called Monte Carlo simulations, right? And what those do is they look at how much money could you take out of the market over time and still make this retirement income work for you, right? And the number that they've come up to is somewhere between 3 and 4% of your principal. And a lot of people call this the 4% rule. So what that means is, if you have $1 million in some kind of qualified plan, you're going to be able to pull out $30,000 to $40,000 a year in income. Well, if you've been able to build up $1 million, the problem with that is that you're going to, living on 40,000 minus taxes, right? So let's say you get to live on $35,000 of that after taxes. $35,000 is not a lot of money for someone who's been able to build up $1 million net worth, right? A big nest egg. So this clearly, this can work on the accumulation side, but it does not work very well on the distribution side, right? Or the way I would say it is, a stock market portfolio by itself is very inefficient on the distribution side, because we have to take into account that there's going to be these drops. And when those happen, if you have to take income right here, you clobber your ability for your portfolio to recover, right? You don't have as much money to go back up. And so what we can look at is, let's say you've got $1 million, and let's say it goes down 35% in a crash. Well, now you've only got $650,000. Well, if the market comes back up 35%, or let's say a third of that, a third of 650,000 doesn't take you back up to $1 million. A third of 650,000 is, what is that? About $213,000. Okay, back up. That's your backup 35%. Now you're only back up to 800 and what is that? $63,000, not a million. So what's deceptive here is a down 35 from a larger number is a lot more money than an up 35 from a smaller number, right? And so when the market recovers that extra 35%, you didn't get back to where you started. Plus, you lost 2 years. This is 1 year that you lost money. This is 2 years. Well, here's what's even worse. Let's say you have to take your $35,000 out when it's down here. So now you've clobbered your ability to recover even more, because this isn't 650,000 anymore. It's 615,000 because you took your 35 grand out. So this back up, instead of being 213,000, might be 205 or 203. And instead of this being 863 after the recovery, now it's $818,000. So in 2 years, you went from $1 million to work with down to 818, and that's after the big recovery, right? And a lot of times the recovery doesn't happen in a year. It takes 2 or 3 or 4 years. So you're having to pull money out before it's fully recovered. The long and the short of it is, that's why even if the market does better than 3 to 4%, because statistically it earns closer to 6 to 7%, you can only pull out 4, because when it's down, it really clobbers. So how can we use another strategy in conjunction with this to protect you, right? And so I'm going to show you how that works, but let me just look and see if anybody has any questions as I'm going along here. Looks like people are hanging with me here, where we don't have a lot of questions, and I've covered this several times, so I know if you're coming back for another helping of it, you may have seen this before. But let's talk about, what can I do to protect myself from these market downs, right? What we want to be able to do is we want to divide our assets, right? So if you have some money over here, and let's say it's in some sort of IRA, right, or retirement account, it doesn't really matter what it's in, and we've got assets there, but we also want to have some assets in something over here. We'll call this a non-correlated asset. So what does that mean? Non-correlated means when the market goes up or down, this asset is not market-based, okay? In other words, when one has a good or a bad year, it doesn't affect the other. In fact, in a perfect world, it'd be really nice if you had something that was inversely correlated, something where it goes up when the market goes down to help offset those losses. But we really want something that's not connected to the market. I'm going to use the example today of what our preferred method is. Like, we love to see people use, and this might sound crazy for those of you who haven't seen most of the stuff that we like to use, or some of my strategies. We actually like to use a specific type of whole life insurance. Now, that might sound crazy, right? Because most people think life insurance is for when I die, not for while I'm alive. But what most people don't understand is life insurance actually has two components. Like, if this is a life insurance policy, there's two pieces to it. There's the death benefit that most people are familiar with, but there's also something called cash value. And cash value is a savings vehicle inside of a life insurance policy. And the thing that makes it non-correlated to the market is it has a guaranteed rate of return. So in other words, the life insurance company contractually guarantees that they're going to pay you a certain amount on your life insurance. Now, at the time that I'm making this video, that's 4%. Plus, if you work with mutual companies, which we do, you also get a dividend on top of that, right? And the dividend rates can vary. They're not guaranteed, but any of the companies we work with are paid for the last 100 years plus. So this might be anywhere right now from 0.5% to about 2%. So the key here, though, is you have a guaranteed rate of return. So when the market crashes over here, you still get your 4% guaranteed. And so what happens is, as the market is doing its thing, right? It's having its ups and its downs. It's going here, and then it's here, and then it's here, and then it's here. When it has these down years and you're in retirement down here, what you do is instead of having to pull your retirement income from your IRA, you come over here and you pull it out of life insurance for that year, right? You pull out your $35,000 or whatever you've determined you can get, and you let this recover for 1 or 2 years until it gets back up to where it's able to support itself, and then you continue to pull the money out of the IRA, right? Year after year after year, and then you have another down year, and that's when you'll pull your money out of your whole life insurance, right? And let it recover, and then you can start letting the market, pay for itself again. What happens with this is all of a sudden we can pull a lot more money than this 4% out, because this 4% is considering that you have to pull money out when you're at the bottom. If you don't have to and you have another asset that will allow you to recover and come back up and kind of get back up to your mark here, so you can get back on track, all of a sudden you can pull out much more money than this, in many cases as much as double. So let me show you a couple of examples of how this works. So let me switch my screen here. So we're going to show you a couple of different kinds of examples. And this strategy, for the record, is called a volatility buffer strategy. The volatility in the market is what creates the inefficiency when the market's not doing very well. And so you have to only take that 4%. So if we look at this is a very conservative 65% bonds, 35% of your money in the S&P. And these are actual returns over a period of time. But let's say you start with $1 million balance here. If your portfolio is going down and you just pull money out, let's say you're pulling 8% out, right, which is more than that 4%, you'll see why this isn't sustainable. So you get 6.3% that year, but you pull out $80,000. So you really got $68,000 of growth, $80,000 of negative. Now you've got $982,000. The next year you get 4%, right? But you still pull out $80,000. And you can see this is the before the beginning of the year. So basically this number, goes down and becomes the number over here. And you can see that over time, you're pulling money out faster than it can grow, right? You're going negative, negative, negative every single year. And you can see here, if we started at age 66, 18 years later, you get $44,000 that year instead of 80. And now you're out of money, right? And that's a problem, because most people, if you're healthy at 66, your chance of making it to your late 80s is quite high. So that's a conservative portfolio. But let's say we have that non-correlated asset in life insurance. And so what we do is you're plugging along, same thing for the first couple of years, and then you have a negative year here, negative 107. So your account is down. It didn't crash, right? But in this case, the bond did good and the S&P did bad. And we know that this happens every 8 to 10 years. In most cases, we're in a really long bull run right now. But the next year, instead of pulling money out of the stock market, you pull it out of the life insurance. And so what that does is it allows it to recover. Usually after you have a down year, you have an up year, because there is a recovery, right? Or 1 or 2 years later. So we went from $785,000, instead of pulling money out and going further negative, we got to recover to $884,000. That's a big difference, right? Now all of a sudden we've recovered some of our earning power as the market recovered. Then we go along and we're getting our rates of return here, right? This is a very conservative portfolio, so you don't see as big of the ups and the downs, right? Going along, but we have another negative year here. We don't pull out that year out of the stock market. We pull it out of the life insurance again, and then we keep going. And you can see here, the other one ran out here. You were at zero. Here you've still got $325,000, and you can continue on with that $325,000, and that can get you through the next 6, 8, 10 years using this strategy. So that's a very conservative portfolio. What if we have something that's a little bit more 50-50, right? 50% S&P, 50% bond. So you're going to be higher highs and lower lows with this, right? Because the bonds are more conservative, the stocks are a little bit more aggressive. So what we see here is, if you don't have the life insurance in place, because there's more volatility, you're ahead in the first year because you had a great year. But as time goes on, you actually run out sooner, right? You run out in year 17 instead of year 18, because these negative fluctuations, especially this one right here, really clobber you, right? They take you from $598,000 down to $435,000. Like that's a really big drop. But if we have this volatility buffer, those downs and ups don't hurt near as much. In fact, you're more successful because the down years, you're taking the money out of the life insurance 3 different years along the way, but you end up with $414,000. The other one ran out of money right here. You still have half your money left if you've used the life insurance to help supplement this, because when you're down, you don't have to pull the money out, allowing your stock market portfolio to recover. And what we can see here is we're pulling out double what that 4% is. We're pulling about 8% out, and we're still successful 20 years down the road. And then if we look at something that's even more aggressive, 60% S&P, 40% bond index, you can see that you run out of money even sooner without the life insurance strategy or the non-correlated asset. It doesn't have to be life insurance, but we love life insurance because of the guarantees and because of the flexibility, because you can access that cash anytime you need it. You actually run out here in, what is that, year 16, especially once again because of this big year in the middle with life insurance. You can see here you've actually got 60%, almost 60% of your portfolio is left after 20 years, and you've had to take it only 4 different times along the way, right? So if we come back over here, what we really want to be able to do is build up enough assets over here to have, in a perfect world, at least 3 to 5 years worth of whatever income that we want to have, right? So if we were taking $80,000 a year, like the scenario showed here, you want to over time have $240 to about $400,000 in assets over here to be able to do that. Now, you don't have to have that from day one. You just need to have it by the time you get to those years. So when we go back to the other scenario and look at it, a lot of those, were pulled 4, 5, 10, 15 years into that scenario. Ideally, being able to amass money over here can be great. And like I said, I'm not a huge fan of the market, but I know a ton of people have money over there. I don't love its volatility, but having a non-correlated asset will allow you to double, in many cases, your income. And obviously there needs to be some strategy, but almost nobody's teaching you how do you use two things together. Now there's ways to do other stuff even beyond that. The investment advisor on our team, I'll just give you a quick scenario. He'll actually, if we just use like a big pie graph here, right? And we've got all your different assets. He will take, and you might have a certain percentage, maybe even 40% of your money, it might be in the stock market, right? And then you might have some money in real estate, and some of that might be in cash value life insurance or other types of strategies, right? There's debt strategies, there's syndications, there's all kinds of different things that you can do. And some of these even may even have tax advantages, right? To help offset taxes or other types of assets. But there's a way to build this portfolio in such a way that you are synergizing. When one asset's down, maybe another one's going to be solid or up. When another asset's suffering, maybe another asset's going to be up. The idea here is to create a balanced portfolio instead of having such high highs and low lows like this. It goes maybe not quite as high, but also not just as low, and not quite as high, but not just as, and over time, less volatility will win the battle and outperform higher volatility in most cases, right? And so we really want to help you build those kinds of portfolios. But I just want you to get the idea that this synergy exists, right? You can create synergy between different kinds of assets and putting them together. So because this is kind of a short training today, I just want to make sure that you get the idea that you can synergize different types of topics. Now, if you have questions, if you want to know more about that, reach out to us. You can reach out to us at biglifefinancial.com, or you can make some comments down below and I'll be sure to reach out to you. Coordinating these assets is really, really important, and almost nobody's talking about it. Most guys, what they talk about, stocks and bonds, they consider that diversification. Maybe they throw an annuity in there or something. But realistically, there are just so many more things you can do. And when you work these things together, you can create a powerful, powerful effect. So I appreciate you stopping by today. If you like this and you're not already on YouTube, you can always go check us out at YouTube at biglifefinancial.com/YouTube. We've got other videos that cover a lot of things. Be sure that you check those out. We've got all kinds of things on more on how the life insurance works, more on different stock market strategies and things. We've got real estate. We've got all kinds of things. So be sure to check it out. But just really appreciate you being here. And especially if you're a high income earner, you're earning 400,000 plus, you probably want to be looking at these kinds of strategies, plus how you can implement those with tax advantaged investments and some of the other things that are out there. That's it for today. Derick Van Ness here. Really excited for you to be stopping by. Appreciate your support. And if you have any questions, let me know down below with the comments. Otherwise, we'll see you on the next video.